Good afternoon to Afore Consulting and Discussion with. Today we have a very interesting issue, which is stablecoins. It's also a bit, as we were jokingly saying, a social experiment because we've got 9 panelists, but actually each individual is incredibly competent and well known. It's quite an achievement to bring all of you together. What we want to explore today is really kind of the definition of stablecoins, how it fits into the international regulatory debate, and what the opportunities commercially, but also the risks are associated with stablecoins. To help us with that, as I say, an excellent panel, and I think I might just start immediately because I think if you want to find out more about the panelists, go on our website. Stasis, I wanted to start with you, Stasis, from the European Parliament's perspective, as chair of also the FinTech Working Group within the Econ Committee. Maybe you could kick us off with some provocative thoughts and questions for the other panelists.
Thank you for organizing this webinar and for inviting me. Well, your title is provocative enough, and who's afraid of global stablecoins? But let me pose, since you asked, another provocative question. Who is against the innovation in the financial sector? And I would think that very few people would say that the innovation is bad, especially in the financial sector, etc., etc. But if anyone would ask me, is all innovation in the financial sector is beneficial for consumers, for societies at large, and also for the financial system itself, especially longer term? Not all innovation is good. Now, moving closer to the subject of the discussion, this number of the crypto assets, I hope we don't call them cryptocurrencies anymore. They could be also called innovation, but are they beneficial in a longer term? Some institutions, some global institutions think not necessarily so. I could quote, a general manager of the Bank for International Settlements calling, for example, Bitcoin the Ponzi scheme and financial bubble. So, when the European Commission issued its action plan back in 2018 and, stated that the innovation is good and its regulation should be friendly to innovation, that caused some interesting developments, including the supervisory competition for some fintech market participants, which in itself affected the market integrity, at least in my country where I come from, Lithuania. So I think that's quite interesting statement that regulations should be technology neutral, but also innovation friendly. So I would argue that regulations should be innovation neutral too, if we want to mention that at all. Now, the financial sector in itself is quite a complicated thing, because of its size, because of its complexities, because interlinkages, because of some business model, be it fractional reserve banking, which results still resulting in market maturity mismatches, major structural issue. So within this environment, and also keeping in mind that the supervision in supervisory architecture, especially in the European Union, is quite fragmented, we have to look at the stable coins, especially global stable coins, within this context. So I think there are at least 2 questions which I keep asking myself. Is the balance of the benefits, potential benefits of the global stablecoins, if we talk about Libra especially, and maybe some other initiatives, be it speed, efficiency, convenience, be it global reach, is it balanced well with the potential problems it could cause, be it financial stability problems, market monopoly or oligopoly, especially if in information, because it's not only the payments, it's also the data businesses that we face with. So, some of these issues are quite, complex. I don't have this answer, but my sense is that, having in mind all these specificities of the financial sector and the complexities, and also the situation in the supervision, especially in the business conduct supervision, which at the European level, systemic business conduct supervision, and that means consumer protection, doesn't basically exist. So I think the balance, at least for the time being, is tilted to a negative from my perspective. Now, the supervision itself is a problem, as I mentioned. So, but the initiatives like Libra is very welcome, and I fully understand, because I worked in the financial industry myself for 10 years or so. I quitted 15 years ago. And I understand that from business perspective, it's quite a logical initiative. You know, there are lots of synergies, lots of gains. There are lots of customer base, data sets, behavioral data, etc. So there is lots of already, business synergies which could beneficial for the business. But is it beneficial for societies, for the consumers? At least in European Union, that's a big question mark. So I welcome very much the initiative of which is partly or to a large extent actually caused by this Libra project by the central banks, and we already talked to the central banks, be it European, be it from other jurisdictions too, that these central bank digital currencies are quite a good alternative to look at and to compare with the global stablecoins. And one specific proposal which could be interesting here is so-called synthetic central bank digital currencies, where the central banks have a role, of course, and then these networks, be it platforms like Facebook maybe or some others, also acting as an agent. So there is a potential synergy when we try to benefit from the initiatives like Libra and others, but also think longer term about financial stability, about the monetary policy transmission mechanisms, and about the implications for the consumers, because the inclinations in business, not necessarily explicit, could be going against the consumers and against the financial stability. So these are my preliminary thoughts, and I'm here to listen more than I talk. So I welcome very much the inputs from other panelists. Thank you.
Stasys, thank you very much for those introductory thoughts. The only thing I would want to add is that we've got a Q&A function, so if others feel equally inclined that they want to kind of put questions in already, please do. But I think the aim is that we will try and address or seek to address some of the questions that Stasys has just outlined. And with that, maybe I pass over to you, Peter, from the Commission side. Of course, you've tried to perfectly address all of these challenges within the MiCA proposal, but I defer to you on that point.
I would say not only did we try, I also think we succeeded in addressing all of these concerns. The question for this panel was, who is afraid of global stablecoins? I think there are many people who are afraid of global stablecoins, but we are not among them. And the reason why we are not among those that are afraid of global stablecoins is because for the time being, they don't exist. And we are not afraid of ideas or concepts. Now, the development of stablecoins, or should I say cryptocurrencies or crypto assets with a stabilization mechanism or a value stabilization mechanism attached to them, is in our view a natural development of the crypto asset market, especially if these crypto assets are to be used for larger scale value transmission and payment uses. The cryptocurrencies or the general crypto assets are just too volatile to use for payment and value transfer mechanisms. They can be used for all kinds of other reasons, and they can be quite successful. And if we look at the market valuations, I think that maybe during this panel, Bitcoin will hit an all-time high record because it's close to $20,000 as we're speaking. Also, Ethereum is creeping up, XRP is going up quite a lot. So you see all of these crypto assets, which are not stable coins, are doing pretty well, but they're very volatile. And because they're so volatile, they're not very usable for payment and value transfer systems. So we're not afraid of this new evolution. We think this evolution has a number of benefits, but we want to regulate it in rather than regulate it out. Our proposal, our MiCA proposal, is not, unlike what many people think, a Libra proposal. It is not about Libra. The European Commission has been looking at this area for quite some time already, and I personally have been involved in discussions on cryptocurrencies and crypto assets and market integrity and stability questions associated with it since 2017, way before we've ever heard of Libra and the Libra Association. Now, I will not hide that the announcement of Libra and the fact and the companies involved in the Libra Association and the potential of these companies has sparked interest and has acted as a catalyst really for the development of our proposal, because it focused the attention of policymakers and regulators around Europe, and I would say even around the world. One of the things which we were most confronted with when the Libra announcement was made was that not only Libra, but also quite a lot of other crypto assets actually fall outside of the regulatory perimeter the way they are designed. Now, that can be by accident or by design, but the fact of the matter was that existing financial services regulation does not, at European level, does not cover crypto assets and many stable coins, or we call them asset reference tokens. And because we want to regulate them in, because we see potential in them, we proposed MiCA as a framework that on the one hand wants to enable this market, because we see huge potential in it, but also has provisions in it to assure the stability of these coins from a financial stability perspective, but also to assure market integrity and consumer and investor protection, in particular as regards the crypto asset service providers, because we see quite a few cowboys on the market there. So our proposal basically has three big elements. The first is about issuance, and there we have rules and provisions on the issuance of crypto assets, both stable coins and the not so stable coins. And in the stable coin category, or we prefer to call them asset reference category, we have provisions on those that are referenced by a whole group of different assets, and then a specific treatment for those that are referenced by a single currency. We call them e-money tokens. The second big part of the MiCA proposal actually covers the crypto asset service providers, which are so far presenting most of the issues when it comes to investor protection, market integrity, consumer protection, and then we're thinking about wallet providers, exchanges, brokers, and so on. And the final part of MiCA is more institutional, and it deals with supervision. We propose that, as far as the European framework is concerned, that the large token issuers be supervised at the European level, and so we need to set up a supervisory framework for this, and that is the third big part of the MiCA proposal. So I think this proposal is, as I said, an enabling framework. It would provide a good place for crypto asset service providers and crypto asset issuers to operate in the EU, but it would also set strict conditions for them to operate. And these conditions are very much inspired on the conditions that apply to financial services operators because of the similarities between the two activities.
Thank you very much indeed, Peter, for giving an overview over the proposal and kind of hearing that the Commission is not afraid of global stable coins. Now, passing on to Doris, I'm not asking the question whether you're afraid or not, but you've been dealing with this proposal, your team has been dealing with this proposal for the last few months. It'd be interesting to hear your perspective, and I think I should say this is a perspective more on the presidency than the German government's position. I think that's fair to say, isn't it, Doris? But it'd be interesting to hear how you have approached this proposal and how the discussions in Council have been moving.
Yes, thank you very much, Nicholas, for the opportunity to present the German presidency views on this issue here. And I mean, one good thing about regulatory success in the EU is that this success has several fathers and mothers, so to say, the Council and the European Parliament being among them. And therefore, we are quite happy to dealing with this proposal quite ambitiously. And as you all know, just today we had a very intense working group on this issue, and the colleagues just finished. And finishing before time is always a good sign. So I think we are a very good way here. I mean, you also know it's for a presidency, it is an advantage and disadvantage at the same time to not have an official view on ongoing legislation, so to say. That is also part of the game. However, most of you are aware that at our Minister of Finance, Olaf Scholz, has been quite explicit on this topic of global stablecoins arrangement during the last year. And with this, he's not alone. His view is shared by several other ministers of finance in the European Union, but also outside, as the international discussions on the G20 level show. And I mean, some of you are also aware that he, together with four of his colleagues from Europe, issued a joint statement in the beginning of September on global stablecoin arrangements, where they pointed out quite explicitly that a no global stablecoin arrangement should begin operation in the European Union until all the regulatory issues are solved. The underlying assumption behind this statement is that, in our view, global stablecoins arrangement primarily serve as a means of payment. And therefore, in this regard, they have the potential to significantly affect the existing payment structures, systems, and instruments. And therefore, we think they should adhere to the same principles as other means of payments do have to adhere to. I think that is one of the underlying assumption of the whole joint statement by the ministers. And we have already well-approved existing European legislation in the field of payments and with good working principles. Some have already been mentioned by Peters. And I think, and we think they should be, they are in a way risk-based and should be applied in the same way to other means of payments, also in order to guarantee a level playing field within Europe. So this may be as a starting point in this regard.
Thank you. And I think we come back to that point about, is to some extent MiCA duplicative to existing European payments regulation or other regulation? I think that raises an interesting point. I think as part of this introduction, Klaus, maybe over to you. The ECB mentioned already a number of times, both through possible issuance of digital euros by the central bank itself, but also I know you've been overseeing systemic risk in payment infrastructures and broader financial infrastructures. How do you view global stablecoins in the context of those two different work streams or any others within the ECB?
Thanks a lot, Nick, and it's a pleasure to join this panel. Actually, I must say, since the original question is who is afraid, a bit like Peter put it, also central banks are not afraid of innovation, and innovation has been a constant feature in the financial markets since its beginnings. We have a particular situation, however, and that is we had a particular period of calm in the area of payments, more specifically, for the last 20, perhaps 30 years. So when we witness now a particular increase of activities in that field, that is, of course, interesting. And it's interesting in particular to the extent that we are in a different setup as compared to earlier instances, because, and perhaps we have to be grateful for the advent of Bitcoin to have been launching some of the reflections. And it is intriguing to see how things come around in circles, with Bitcoin originally launched as a means of payment when everybody had been focusing on the technology, and now we are back on the payment propositions and the changes to the payment ecosystem. What is different this time is that we witness a combination of different technologies, tokenization, the use of platforms, the entrance of new players, non-banks or big tech companies, but also, and that's perhaps also different to what we have seen with the advent of e-money about 20 years ago, this time there is a concrete user demand for 24/7 convenient and cheap payment solutions. And this together actually puts us currently in a very particular situation, which is emphasized by what I would call a perfect storm, which has increased the attention. We have the combined impact of COVID, which has been pushing towards digitization. We have the propositions for global stablecoins, and we have the discussion around central bank digital currency, which all play together. And of course, this is raising fundamental questions on how the markets and the payment ecosystem should be structured and regulated. So from that perspective, I think it's fair to say that even if you're not afraid, you should focus on the concrete issues. And to the extent that there are new propositions, one fundamental novel element of stablecoins is they're not just offering an incremental change like a new product. They are offering the potential for an entirely new payment ecosystem. And that, of course, raises questions to interoperability with other payment channels, concentration issues, but also fragmentation that need to be addressed. And from a central bank perspective, you have been putting the point on this particular aspect, Nick. This is of particular interest because there are a couple of perspectives which come into play here. Central banks, as you know, not only conduct monetary policy, they also provide services in the infrastructure domain. Payment system services. More recently, the Euro system has been engaging very actively in the area of instant payments through tips. Indeed, there are discussions around the possibility to consider various forms of central bank digital currencies, their merits or their limitations. And in this respect, perhaps one small reaction to Stasis. I was never a friend of the term synthetic CBDC, and I had long discussions with my friends in the IMF on this, because I believe this is a black and white scenario. Either you have a central bank digital currency or you have not. Synthetic probably doesn't exist, but what you talk about is whether you can actually transmit and put in the market a CBDC through intermediation. So again, that is something which we can discuss, but it doesn't stop at the provision of services. Central banks also have a catalyst mandate, and this is to foster the integration in Europe for integrated financial markets and integrated payment services. And here, building on the achievements of SEPA, one needs to consider how new solutions fit into this overarching domain. And perhaps the last point, and one which we can look at a bit more in detail in the subsequent discussions, indeed, central banks also have a role to play as regulator and overseer in the payments domain. This is a statutory task, and we have been looking at payment systems, but also retail payments for quite some time in the Euro system. And indeed, the advent now of new players, new services, raises questions that Peter has very rightly laid out about what is the regulatory parameter. Do the existing frameworks adequately cover these type of activities to the extent that they resemble traditional payment system or payment service functions? Are the sets of oversight requirements sufficiently neutral? Are they proportional? And also perhaps should you consider the approach? Do you actually want to focus rather on entities or take a more functional approach? And I think with this as a warm-up, I leave it and I hand back to you, Nick.
Thank you very much indeed, Klaus. I think it's very interesting. I think both you and Doris have kind of pointed out, that there is a market need. I mean, it's been mentioned by many, but there is a market need potentially for these stablecoins, but they're the only ones who can provide that market need or fill that market need is a separate issue, but there is clearly a demand there for these products. And I think we might come back to that. I think I would now like to kind of turn to the international side, because we've got Sharon from the US Treasury with us. We've got Barry from the Bank of England. And Eduardo, I know you're here to represent CREL, so one of the providers, but also you're joining us from Mexico, and you have a perspective on how the Mexican Central Bank has responded to this. So maybe, Sharon, I start with you, both on the US side, of course, you're looking at this, but you've also played a very prominent role in the international standard setting bodies, which are becoming more and more vocal on stablecoins, and ideally also trying to bring together some coordination at the global level between these different national and regional initiatives. So maybe over to you.
Great, thank you, Nick, and thank you for the opportunity to join today's panels with my European colleagues and market participants. Just to start off with some of the provocative questions I think this has posed to this panel, I would say up top that Treasury does welcome responsible innovation, and we do think that it has potential benefits in terms of increasing access, efficiency, decreasing costs, and the like. At the same time, I would echo some of the thoughts that Klaus and Peter have mentioned, that of course responsible innovation means that public authorities should be very thoughtful about how to appropriately regulate this. And to your point, in terms of market need, I think a lot of these conversations are not new. We have historically discussed the appropriate roles for public and private sector provision of money and the movement of money. But I would agree that the technological developments that we've seen in the last couple of years have really accelerated and as Klaus mentioned, really catalyzed, I think, these conversations, and are worth having us take another look. I do think that a lot of these innovations are trying to address an understandable existing frustration with some inefficiencies, particularly in the cross-border payments system. And I think it's with that in mind that there has been an effort, as you mentioned, Nick, in the international forum for some work and good thinking in this space. So I can speak a little bit later about some of the U.S. regulatory approaches, but first, in terms of international work streams, perhaps I will highlight 3 work streams that U.S. Treasury has taken some leadership on. One is in the Financial Stability Board, regulatory issues of stablecoin work, which several colleagues on this panel have also participated and contributed to. 2 is our work in our current G7 presidency in standing up a digital payments experts group that I co-chair with Federal Reserve colleagues. And 3 is again, the FSB's forward-looking work on cross-border payments and that upcoming roadmap effect on stablecoins and other types of digital payments. So on the first item, the Financial Stability Board Regulatory Issues Stablecoins Working Group, or what we call RIS or RIS, was very much tasked by the G20 to identify existing and regulatory supervisory frameworks that could apply to stablecoins and assess what a comprehensive approach would be. That report was issued last month and essentially noted 10 high-level recommendations to address potential challenges. And the approach there was very much, as colleagues have kind of echoed, an attempt to take a more functions-based approach, given the multiple different types of functionality that can be in a stablecoin arrangement or ecosystem, to be technology neutral, and to be guided by what we call the same business, same rules, same risk, same rules principle. Essentially, stablecoin arrangements, to the extent they are exhibiting a similar activity or same risk, should abide by the same requirements as existing activities that pose similar risks. So to take a more principled basis. And I think this will allow more of a level playing field approach between existing and new technological innovations, as well as mitigate potential regulatory arbitrage considerations. In the G7 Digital Payments Experts Group, we call DPEG, during our host year, given all the good work that existing standard setting bodies are doing, the focus there was a little bit more on some of the public sector considerations, including, as Klaus mentioned, things like monetary policy issues, currency substitution, and really we issued a statement in October, where the G7 expressed a commitment to transparency, the rule of law, sound economic governance that really underpin the current international monetary system, and the that work also brought together finance ministries and central bank colleagues, including some, again, on this panel today, to assess the long-term risks and opportunities associated with digital assets and the roles of the public and private sector. The last point that I would note is the work the FSB Cross-Border Payments Group and CPC, and that's really going to be, I think, the FSB's forward-looking work in this area, including in stablecoins, which will look to address some of the same pain points that potentially we're hearing from market participants, and lay out more forward-looking work in terms of assessing standard setting bodies, application of existing standards on a kind of same activity, same risk, same rules approach to stablecoins. And I think in this manner, this helps us really be able to welcome innovation, but also address the other public policy considerations the public authorities will have. Thanks, Nick.
Thanks, Shan, and thanks for highlighting those 3 work streams. And I think the last one I find particularly interesting because you're right, stablecoins are part of it, but really it's a much broader initiative under the Saudi Arabian G20 chairmanship to look at cross-border payments and inefficiency in payments and remittances. And to some extent, I always saw it as a bit of a response to the, imminent emergence of global stablecoins and looking at some of the more conventional payment systems. A very interesting development. And we come back to the domestic side in the US in a moment, but maybe Barry, I'll pass over to you first on the UK side, because of course you've been very active in this as well. Your governor has been quite clear on some elements around global stablecoins. How do you see things?
Thanks very much indeed. First of all, I'd like to maybe start by picking up on Klaus's remarks. I think really the way I see it is that we need to think about where stablecoins fit in the existing landscape. And in that regard, central banks themselves, such as the Bank of England, have got 2 hats to wear, potentially as providers of a central bank digital currency, and secondly, as overseers of payment systems and guardians of money, which people use for spending in day-to-day transactions. In my view, my personal view, the jury is out on whether to be afraid of stablecoins. But what is clear is that stablecoins have the potential to bring efficiencies to payments and to promote financial inclusion, and people have touched on that already in their opening remarks. However, a widely adopted global stablecoin could very easily become as systemically important as a means of making payment in and across one or more jurisdictions for exactly those reasons. And that's my main focus at the Bank of England. Digital currencies, as our governor has said, are not just a new type of money. They also bring their own payment infrastructure. So when considering how we regulate them, we must look at both the payment and the money aspects of stablecoin, both domestically and globally. Taking a functional approach, I agree, and one that is technology neutral. And we need to encourage and support innovation as long as we can do that safely. In the UK, as we've just said, our Financial Policy Committee has set out its expectations for systemic stablecoins used for payments. And these highlight the importance of maintaining confidence in money. In particular, stablecoins must meet equivalent standards to those that are in place today for other forms of payment, and equivalent standards to those expected of commercial bank money in relation to stability of value, robustness of legal claim, ability to redeem, all the things we'll touch on later in this panel. And as Sharon mentioned, the FSB recognised in their report just in October this year that regulators must have adequate tools and resources to regulate and supervise stablecoins. And in the UK, the Ministry of Finance announced on the 9th of November that the government in the UK is going to consult on domestic legislation to make sure stablecoins meet those same high standards we expect of other payment methods. We also, of course, remain committed to international coordination. There's a lot of work going forward, as Sharon just outlined, because where stablecoins are global, common standards and very close cooperation between authorities is absolutely key. In my view, a clear and strong regulatory framework is a very important component for the success of any significant innovation in payments. People need to be able to have trust and confidence that payments are going to be made and that the medium they're using to make those payments is reliable and well backed. And that, I think, is the challenge that we must set to stablecoins in order to work out whether or not we need to be afraid of them.
Thank you very much. I think you bring in an issue that we want to explore later, which is kind of the stabilization mechanism and the difference between different crypto assets and stable coins. And also I've seen 1 or 2 questions come in around that, which I will integrate into discussion. But before we get there, kind of switching half over to the industry, because Eduardo, obviously you speak on behalf of the industry, but you've got the experience of what you've seen in Mexico. I mean, where do you see the benefits of stablecoins? Because I think you've seen some of this already emerge in Mexico. And secondly, coming back to Stas's points right at the beginning, finding the balance between consumer protection, protection of data, protection of conduct rules. How is that balanced, or how do you think that should be balanced with the, let's say, commercial interests or the economic interests of maybe making stable coins a success?
First of all, thanks for the invitation. Glad to be here and meet you all. First, well, Mexico was the first country in Latin America to issue what is called the fintech law, and it addressed in part crypto assets. So everybody was very eager about that. Just to give you a brief understanding, there is, the amount of investment accounts in Mexico has been steady at around 200,000 for the last 15 years. And just in 4 or 5 years of existence, for example, the largest exchange here in Mexico has around 700,000 accounts. So you can see there's a lot of interest in Mexicans on using crypto in general. Then when the law came out, it granted the central bank authority to regulate the use of crypto by financial entities. So what they decided is that financial entities, due to the volatility of the asset, cannot grant any sort of exposure to their clients. They don't want clients thinking that cryptos are backed in any way, any sort of crypto, by the financial system. So what has happened is that people are still using crypto. The only thing is they are using it either through unregulated entities or through foreign entities that could be set anywhere in the world. So you might have some people operating with exchanges or crypto providers that are in very, let's say, developed and regulated countries, but you also have some of them operating in anywhere in the world. So there's, a public policy question there on whether you rather have people doing things on your house, seeing them, or you just want them to do it outside, and so it's not, something that falls on you. That's, as some have said in this panel already, each central bank has a different stance on crypto. What they have allowed is crypto to be used by banks and fintech companies for internal operations, including remittances. So one of the important things to mark here is, the remittances market in Mexico represents around $4 billion per month. And right now, there's now a really official number of this, but around 8% of that is being done through using some sort of crypto. Normal Mexican nationals that are residing in the US and sending money back home are using, the regular money transmitters, which is really, really expensive and really, really inefficient. So many players have seen the use of crypto in general as a way to make more efficient remittances. And obviously stable coins play a big role in that because of the stability they could provide to that market. So I think that's something that is worth, mention. Is not only payments, but also remittances has a big use, a key use in developed countries such as Mexico. And I think that another thing to keep in mind is it will be interesting to follow how things happen, in Europe with MiCA, etc., to see what parts of that can be adopted in a country like Mexico, which is very eager to use crypto in a more, more mainstream manner. I would say that having some clients that work on that part, they say that even their customers are very very passionate about their crypto. It's so I would say it's there. People are using it. It's best to address the issue than to try to avoid it and just look the other way. I'm not saying that has happened in Mexico. This was the first country to regulate crypto in some way in Latin America, but certainly I think the next step is to see what happens in developed countries and try to adopt some of that here.
Can I ask you a small follow-up question, Eduardo, which is, in the use of those, let's call crypto assets or stable coins, to what extent is the element of stability that, Peter referred to and some others refer to relevant in the uptake? Are customers willing to take, I know it's kind of covered through financial institutions, but how do customers treat the volatility of the product? And how do you interpret, as Peter said, that Bitcoin is shot through the roof in recent months?
I'd say there are two types of people using it. The ones that are trying to get rich with these price swings, which is a big chunk of people trying to do this. They're trying to speculate on it. But there's a big case to be done, for example, with stable coins pegged to the dollar, for example. So a lot of people doesn't really know how to make a bank transfer from their bank here to the US in dollars. And this is an easy way to do it. At least, there's, a whole discussion to be had if whether it's more cheap or not, or whether it's efficient or not, but at least it's an easier way to do it. So that's one particular thing. Normally the type of people, you have two types of remittances, basically. Corporate remittances, which is people that have their own, banker that helps them do everything they need to do. But in amount of transactions, the bigger one is, regular folks trying to send money back and forth to their family in the US. So for that people, they don't have access to that sort of banking services. And they do have access to open an account in a crypto exchange or a crypto provider and then send the money to someone in the US. So that's, to tell you the truth, that type of customer is not very sophisticated and is not necessarily concerned about the stability or not. They just want to be able to send the money to their kid in the US because they need it or back. So, for example, to protect those type of customers, it would be very relevant to have some sort of regulation. So Banco de Mexico regulation says that they can approve the type of digital assets that will be used by banks in Mexico or fintechs based on, the use it has, these coins are having in other countries, and also the sort of, the protocols to create and multiply the assets, etc. So they haven't authorized any. So it would be interesting to see when they do authorize them how they can use them. But most of the banks are not necessarily interested in entering this market, and fintechs, what they've done is divided their crypto business and send that elsewhere, and they just do pesos here.
Thank you very much. That's interesting. I want to come to Philip now. Because Philip, you've been studying this market for a long time and the developments around the markets. How would you describe kind of the use cases, the demand, and just the evolution of this market? And how do you think the regulatory initiatives that are being foreseen impact that?
Yeah, that's an absolutely important question. What is happening in this market now, and what is basically happening in this market in the future? So let me quickly sketch out 5 domains where I see stable coins being important in the future. That's what we just have heard from Mexico. That's remittances and financial inclusion. I think this is one of the key domains which is affecting the retail market. It's private individuals. Then second, we have in my mind, the entire capital market. That's basically trading of securities, assets, tokenization, and so on. So the capital market is the huge second domain. And third, we have, let's call it the industrial complex, the industrial area, where especially companies in Germany would like to have some kind of blockchain euro for their future business models. That would, for example, be autonomous devices, autonomous driving, manufacturing, and so on. That's the third area. And related to this, I think we will see some kind of machine economy evolving, the economy of things. And in my mind, a stable coin or a blockchain euro or whatever would be best suited to support the machine economy, which is more and more demanded by companies. Yeah? So, and then there is another domain which is interesting, because all domains which I just have mentioned, they will just happen in the future. They are not there yet, and there are no solutions out there which are servicing the domains out there in terms of stable coins. And the last domain here is the crypto asset domain. I think that's interesting because here we can observe how stable coins are actually running, how they are working right now. And of course, they would here and there need to be regulated because people are quite freely doing what they want in the crypto domain. And actually, I missed one area, that's the retail segment in a national country. So if I'm transferring money to my friend, my neighbor, to my family, this is in my mind not relevant to stablecoins, right? So that's the key domains which we are seeing right now, and most of these domains will just grow in the future, and only the crypto asset domain can be observed right now in the present time. And what does it mean in numbers? Just to give you some numbers, we have the project called Tether. That's the largest one, capitalized with 110 billion US dollars. This, for example, needs to be contrasted with the market cap of Apple alone, which is 20 times larger than Tether. So Tether is, well, large, yes, but not as large as, for example, corporate valuations. And it needs to be contrasted with the US money supply, M2, which is at this point of time 80 trillion. Yeah, so by far, these money supplies are larger than what we see currently in the area of stable coins, but still 110 billion in terms of existing stable coins in the crypto asset field is definitely significant. Then we have the DAI project from MakerDAO, and we have Libra, which wants to start in the market soon, but which is not live yet. So Libra has a market cap of 0 at this point of time, but of course will be a relevant project in the future. And let me now talk 1 minute about regulation. So we have quite some large projects out there in the area of crypto assets. And in my mind, they have become so successful because they are open loop systems. So I can take out the US-backed stablecoin Tether and transfer it to my account, which is amazing. I do not need to KYC myself. I don't need to prove my ID card to a bank. So this kind of open loop system made them quite successful. And this needs to be contrasted with smaller projects of stable coins which are out there. In Germany, we have Commerzbank, for example, and also Bank von der Heid in Munich. They operate closed loop systems which do work, but because they are closed loop systems, like small ecosystems, they are of course smaller. And what happens now is that the European Commission proposes the MiCA regime, and I think this really needs to be valued, that like such a regime is being proposed for an entire continent of 450 million people with one unified legal regime. That's in my mind really fascinating. But we are seeing now something very interesting, because the MiCA regime proposes stable coins primarily in case they are referencing the euro or the US dollar, for example, then they are becoming so-called e-money tokens. And this is now contrasting with those stable coins which are already existing, because the existing stable coins, Tether, for example, would not directly fall in the MiCA regime. So Tether and the other projects would have to decide whether they are trying to get a license by the European Commission or national authorities, or whether they would like to leave out the European continent as a market. Yeah, that's interesting. So entrepreneurs have done quite freely what they felt in the crypto domain. Now the European Commission says in the future you have to have a license for this, and then we will see whether these quite large projects already 100 billion US dollars, how they will decide whether they will not tackle Europe as a market, or whether they try to get a license for this. That will be interesting, and actually it's too early to value this question, but it's interesting to see how growing companies are now meeting the demands of the regulator. And last comment from my side, as I have explained, there are a couple of companies driving this development for stable coins, partly global stable coins, yes. And I think another segment of global stablecoins will be the synthetic CBDCs that could be, for example, joint public-private partnerships where a central bank is jointly collaborating with commercial banks or distributors, and this could be something very interesting for the next years to come. But of course, this needs to be sorted out. Because at the end of the day, I would expect that the e-money token, according to the MiCA regime, that's what the EU would like to have, should be regulated such that it's working similarly like a PayPal, right? We are sometimes complaining about global stable coins, but at the same time, we have PayPal, which is also moving around billions. Nobody complains with it, which is fine because they are regulated. And that's why it's a fascinating area to observe and to basically expect future developments.
Thank you very much indeed, Philip, because I think if you identified 5 use cases, but if I were to distill it a bit, and please come in if I do you injustice, but yes, there's kind of, you said the retail side is maybe not that interesting, but clearly in the remittance space, it is one that is, relevant. We've seen it just from Eduardo. It's the one that's grabbing a lot of attention, public attention, because of the consumer protection side. But actually, other use cases are much more business to business, or as you say, which I find very interesting, the future Internet of Things, machine to machine. It's kind of somehow integrating payments into the evolution, into kind of industrial 4.0 policies and so on and so forth. And that's maybe also why there's some excitement around stablecoins and the role they can play in this area. I want to come back to the stabilization point in a moment because I think it's really important. But before doing that, obviously, Dante, I want to come to you. I'm going to be provocative. Is Libra going to be kind of the payment solution that looks ahead into these future developments? And to some extent, maybe to bring me to kind of open up a little bit into the next round of discussions at the end, how will you deal with the stabilization mechanism? You were envisaging some form of a basket originally, but under MiCA, an e-money token wouldn't give you much flexibility as to how you manage your stabilization mechanism, but it could be potentially extremely expensive to manage.
Sure. Well, first, Nick, thank you and colleagues for the chance to defend the case for global stablecoins. As the promoter of a global stablecoin on this panel, I'm hopeful that the audience and you yourselves are not afraid of what I have to say, me, or the proposition. In no small measure, because you could also ask the rhetorical question in the inverse: which cryptocurrency promoters are afraid of regulation and regulatory certainty? We are certainly not, and I think that is evidenced by the fact that we viewed regulatory alignment and regulatory approval as an important precondition of launching the Libra project. And I think that's evidenced not only by the ongoing work we've been doing with groups like the Financial Stability Board, co-chaired by the United States and Singapore. The engagement we have with the Swiss financial regulator, FINMA, is an engagement that's a multi-stakeholder engagement comprising more than 20 jurisdictions and counterparties who are submitting their view to what is nothing short of a consensus-based approach, a principled approach, and a technology-neutral approach to allowing these types of innovations to thrive. At the same time, I do think we have to look at ourselves in the mirror in the West and in many jurisdictions around the world and ask ourselves important questions about the state of private sector innovation. After all, the vast majority of money in circulation today is, in fact, privately issued. It's issued through the two-tier banking system. It often labors under fractionalized banking. We learned crucial and painful lessons about the limitations of that financial model in 2008. And yet again, in the context of the COVID-19 pandemic, which we have to look at with great interest, not only for the limitations of domestic payment environments, we also have to look at it in terms of limitations of cross-border payments, and how an operating model that is largely analog, where the value transfer mechanisms are certainly not internet ready, let alone scalable to the scale of populations, have introduced quite a lot of risk. I've always maintained that these types of innovations are about optionality and completing the financial system, not necessarily competing with it. And I must applaud, in my role as a commercial and regulatory diplomat on this panel, I must commend the Europeans for building a pan-European approach in the MiCAR proposal. MiCA could be to crypto assets what GDPR was to privacy. And so while in the short run, it might cause some consternation amongst private sector operators, then we have to be careful not to overdo it in that it might push innovation offshore. This is an asset class, as evidenced by Bitcoin and a near $400 billion market valuation, that is desperately looking for regulatory clarity and financial certainty. If we get it right, the advent of stablecoins and the long-range proposition that these types of open source networks would support central bank innovations in the form of CBDCs, those innovations need rails, and those rails should be public-private. Neither party, the private sector nor the public sector, can complete this assignment. The job is too big for any one sector to take on its own, and it requires, frankly, too much public sector oversight before it can reach the type of stability and trust from users that they deserve. The other point I would make is perhaps even bigger than thinking of this in one context or one regional context. It's the global alignment to the Sustainable Development Goals. We live in a world with 1.7 billion people with no access to the formal economy. They are plagued by opaque, dangerous financial systems. They are plagued by the limitations of cash, which are very hard to interdict when it comes to financial integrity. And yet the cross-border cash flow remittances is the largest cash flow in the world. It's greater than foreign direct investment and official government development aid. So in a world in which a simple internet-connected mobile device can become a compliant payment endpoint that lowers the cost of cross-border transactions, I think we all collectively have an obligation to figure out how to ensure that financial innovation, financial inclusion, and financial integrity are not seen as trade-offs, but rather the three things can move together. And so we have been deeply committed to that regulatory engagement and that regulatory oversight. But I also would point out that this is a hyper-competitive domain. We see it in the attempts at launching $35 billion IPOs from mobile money platforms coming from Asia, an IPO, an initial public offering that would have been greater than Saudi Aramco. We see it in the void that is being filled for the lack of these types of low-cost, high-trust payment networks around the world, and many alternatives that are not necessarily conversant to the global compliance frameworks and the rules-based system that many of us take for granted based on nothing more than the country we were born. So I propose a model in which no one should be afraid of global stablecoins, let alone financial services innovation, especially in a world when we have so much work yet to be done that we have yet to complete. So with that, of course, happy to take any questions.
Thanks. I might come back to you in a moment, but I know, Barry, I would like to come to you very briefly around the stabilization mechanism and the whole question. So we have a debate between asset-backed reference tokens and e-money tokens and the link to stability. How do you think, A, the basket should be managed or the stabilization mechanism should be managed? And a follow-up question, which also came from the audience linked to that, is the latest Basel paper, Bank for International Settlement paper, talks about the lack of a liquidation regime or the need to have a liquidation regime. So how do you see, what defines stable and how should stable be managed from your perspective, from the Bank of England's perspective?
Thanks very much. I thought it was really interesting there that Dante mentioned and made the comparison that much money is, of course, already privately issued, and from a Bank of England perspective, that's our starting point really. I think the baseline against which the reserve structure of systemic stablecoins need to be judged is that which currently applies to commercial bank money, and it may be the case that equivalent protection to a commercial bank deposit is achievable through various combinations of prudential, capital, reserve, or other backing requirements. There needs to be further discussion, I think, to work out exactly what it is that can apply there. But I think it's very important to recognise that if you consider a stable coin that does not include a legal claim for coin holders or proposes backing in instruments that may have material market credit or liquidity risk, and does not therefore have associated money protections, depositor protections, etc. While this might be of interest to investors for speculation, it's not going to be something that we would expect to be used for payments at systemic level. So I think the comparison that Dante is driving at to commercial bank money is the right one. The question then is, how do you achieve equivalent protection to that which exists in commercial banks at the moment? And there are probably a number of models out there and ways of doing that. And I think that is the stage we're at in terms of discussions in this space. And there needs to be more commentary on that, I think. In relation to the Basel paper and the question that was asked on resolution frameworks, just very quickly, absolutely, it's very important that if these models are being used for payments by people going about their day-to-day business, that there are arrangements for people to redeem those payments, even in a situation where the provider of the coin has gone out of business or has had some sort of terminal operational issue. And that does involve some sort of resolution arrangement. It probably involves thinking about interoperability between stablecoin provider, so that one can pick up the sort of failed but still operable parts of another, and potentially again making the commercial bank link, thinking about compensation arrangements, depositor protection schemes. There's quite a lot of things to think about, I think, in this space. But I think Dante's starting point is right, but it's not yet clear to me where the end point is in terms of providing the protection that people currently expect and should continue to expect in the future for their payments.
Thank you very much, Barry. I would like to bring in Klaus, also from the ECB's perspective, just again on the stabilization mechanism and what defines a stable coin from other type of crypto asset or an asset-backed kind of token. So how should this be designed, and what would be your expectations to define it as stable?
Thanks, Nick. I think it's not the role here of public authority or a central bank to define how a particular arrangement should be structured, but it should be defining the parameters that mitigate risks that may arise. And one aspect which is key to me here in the debate is we need to be aware we are talking about an ecosystem here where particular functions are spread around potentially a high number of different entities and providers of services, and you need to have a holistic perspective to address the risks that arise in some or all of these members of an ecosystem. For the stabilization mechanism more specifically, again, we know these kind of functions from other areas. We just need to apply, be able to apply the appropriate requirements to the underlying arrangements. Again, I would like to come back on this on a point that Doris made, because if you look at a stablecoin ecosystem, at the heart of it is a transfer arrangement, and a transfer arrangement is a payment system. And for the payment system, you should apply the same kind of requirements that you would expect in terms of risk mitigation from a traditional payment system. There are some ancillary functions, and the stabilization mechanism is one. If it is defined or designed in a way that it resembles something we know already from traditional infrastructures, payment systems, like a guarantee fund, then you should apply those requirements. If it has a different economic function, where it more resembles a kind of investment type structure, then you should see how you can make sure that the more investment specific risks are appropriately addressed and mitigated. And the issue about how you deal with a situation of resolution that Barry also alluded to, this is of course particularly difficult in a setup where the responsibilities or the direct legal relationships are spread around a wide array of different entities. And perhaps one short advertisement here in this respect, Nick, if I may, because again, this is an area where the central banks, in particular the Eurosystem, has been active for a very long time. We have been providing oversight frameworks for payment instruments and schemes for a very long time. And this is exactly this kind of more specific risk-based functional approach that may come into play here. We have actually, as a complement to the MiCA proposal, launched a public consultation on what we call PISA, the Oversight Framework for Payment Instruments, Schemes and Arrangements, which is looking exactly at these ancillary functions surrounding a core payment system and the specific risks they pose. Payment instruments, which traditionally were e-money, credit transfers, card payments. We are taking now an approach which is purely functional, where we do not look even at transfers of funds, but transfer of value, so that we can also address the risk inherent to a token payment transaction, applying the same kind of expectations to these kind of transaction. Payment schemes. You have in a payment ecosystem like a stablecoin arrangement, specific entities who define routes. You have this already in traditional card schemes. But again, to the extent that you have these kind of governance authorities, you should apply the same kind of requirements to these entities. And lastly, and that is a novel aspect that I want to share with you for some of those aspects, we have been defining a new category of payment arrangements, which is looking at the user-facing type of activities that are in a payment ecosystem, which are aggregation services, which are data management, data storage, which are wallet service provisions. And again, we submit this to a harmonized regime of oversight requirements going forward. And of course, we will be very interested to hear the reactions from the industry on our public consultation that is still ongoing at this point. What I would like to stress is, again, my starting point, the holistic perspective, because you need to look at all the individual aspects in a manner that you don't create duplications, overlap, but you also don't have gaps in this framework. And in this respect, the PISA framework should be seen as a complement and as an additional element to the MiCA proposal and the more wider digital finance package of the Commission to make sure that we have a robust and all-encompassing regulatory framework for payment structures such as stablecoins in the European Union.
Thank you very much for raising this, because in the European context, I agree that really in the market we have to look at PISA, the consultation you're referring to at the moment, or just now, is kind of a parallel initiative, but complementing initiative to MiCA. And I think for anybody who wants to operate in the stablecoin environment, both sides will be relevant, particularly if they provide payments. But that is, I think, where I wanted to come back to you, Peter, because what's becoming clear is, yes, maybe a stablecoin has other functions, but its core function is payments, payment provision, in one form or another, retail, machine to machine, business to business. So, and this is also a question that came in, so why the distinction between e-money tokens, where it has to be really very stable, and the framework of asset-backed tokens? Provocatively, you know, if you seek a license as an issuer and you want to do all kinds of things with your stablecoin, including invite people to invest in them, you're much better off going for the asset-backed framework, and you don't have the same obligations of stability. Where's the trade-off between those two elements? And the second question, I think, linked to this is, you know, recognizing that stablecoins are stablecoins, do we really need to bother much about anything other than using them in the payments context? Are we over-egging it a little bit in MiCA?
No, I don't think so. We're not over-egging it. We do not want to prescribe any particular business model. What we did with our proposal is we looked into the market at what is out there, what does exist, what exists, or what is planned, and how can we create a framework to enable this, but also regulate this and stabilize this. And to come back to your earlier question, well, what is stable, what is stability? It's a very relative concept. Something is stable in comparison to something else. And so the e-money tokens which we have in the MiCA proposal are tokens that reference a single currency. So they are stable, they must be stable vis-a-vis that currency. And for that reason, they are the same as e-money. But we see other models, and Dante's organization have proposed, and they still propose, to the way we understand it, a model where the token could be backed by a basket of currencies. Now, that may be, relatively speaking, stable, but it'll never be denominated in a single currency. If you've got a basket Libra, its value will fluctuate vis-a-vis the dollar, its value will fluctuate vis-a-vis the euro, its value will fluctuate vis-a-vis the pound, and so on. So if we didn't have this category of asset reference tokens, this basket Libra, you wouldn't be able to place it because it's not e-money, because if it were e-money, it would have to be linked to only a single currency. But yet it is more than a general crypto asset, because it does have a reserve, it does reference an outside value, and that outside value must be managed and protected. So that's why we created this category. Whether or not asset reference tokens would be widely used for payment purposes, it's hard to say. At this stage, I would say I don't really think so, but that's just my own view. I think regulators, and not just the European Commission, but regulators around the world, are usually very bad at predicting what business models make sense. And we are not in this business. If I were to in the business of deciding which business models make sense, I would be in another job. Like 20 years ago, who would have thought that you can make money with a site where people post pictures of their cats, their dogs, and their food, and that this is you can create a very big company out of this? or that with little clips of 15 seconds or whatever it is, you can make a company, or that by sending texts of 156 symbols, you can create a company. Most people said that that's insane. There is no business in that. Yet, clearly, there is a business to be done there. So, I'm not going to make any statements as to whether or not the asset reference token business is a viable business. It is there, and we want to create a framework for it and make sure that the companies that do choose that license are properly regulated and properly supervised. And then it is for the business community to decide which of the licensing categories which we have suit them best. But of course, they'll have to make choices because we can't create a license for every single variation that is out there in the market, or we would need 50, 60 different categories, which would be insane. So we've created a number of categories which we think represent the main groups, and companies have the responsibility to choose which category they want to be in, and probably they'll have to slightly adapt their business or they'll have to seek a license if they want to do business in Europe.
Thank you. Maybe I can follow up with one short subsequent question, and that I will also direct at Doris subsequently, which is, I'm going to be deliberately provocative here. If you don't want to preclude anything, but you mandate that really for payments purposes, effectively you have to use an e-money token, and that needs to have a regulatory capital on it of 3%. And it needs to have a stabilization mechanism, which costs a lot of money because you need to convert 1-to-1 at any time. That becomes quite an expensive instrument to run just to use for payment purposes. And if you then have an attractive CBDC being provided by a central bank, which costs the central bank, yes, a bit of IT power and so on and so forth, but it doesn't really cost anything to run per se, have you kind of not regulated private solutions out of the market before they've even kind of kick-started?
Not really. What we don't want to facilitate is the creation of private money in addition to what we already see in commercial banks with fractional reserve banking, and that's properly regulated. And so commercial banks generate money based on their reserves. We did not want to replicate this because if we look into the business model of e-money, the issuance of the e-money itself isn't really a profitable or viable business because the investment rules that exist for the float and the capital requirements that are out there, and you still have operational costs to run it. But if you create e-money or now e-money tokens, you can place these into other services, payment services, value transfer services, and it is in these services that the profit sits. And that's also what the market participants have told us, that large social networks, for example, are willing to, if you wish, almost subsidize the Libra Association because they would create a token that they can build services on. And it's these services they can build onto this payment, onto this token infrastructure that are the business. But the management of the token itself, or the investment of the float, or speculating with the float is not our idea of a sound business, because we do not really want to encourage fractional reserve token issuances. And that's why we have the prudential investment requirements on the reserve as we proposed.
Okay, thank you very much. Maybe Doris, over to you. You had highlighted at the beginning, the efficiencies and building on the efficiencies of the existing payment systems. I mean, you've heard now the conversation around the central bank issued currencies, but also what Philip said, slight concern that creating it too. I take, Peter's point, we can't have 1,000 different definitions, but it might be hard squeezing existing business models into the few categories that are being foreseen. I mean, how do you view this, and what has been kind of the initial reactions from within the Council Working Group, or also your internal discussions within Germany on this?
Yeah, thank you. Yes, of course. This issues which are raised by you are also part of the discussion we are facing at the council, in our council working group at the moment, and which are highly debated there, with similar arguments you put in place here. I really like the thought of Klaus at the beginning that things come back in circles. And of course, we all know global stablecoins arrangement may differ from existing e-money regimes, from existing payment systems and services due to their ecosystem character. I think it's still worth on look on some of the European legislative discussion we had actually years ago on the European level. And in years ago mean in 1998, in the margin of the EMD1, the e-money directive 1. Back then, the EZB already issued a report on e-money. You still can find it on the internet, and it's worth reading. I can recommend it because the EZB points clearly out with regard to e-money and the issuance of e-money that this is likely to have a significant implication on the monetary policy. And therefore, it's very important that stability is guaranteed, and especially that the unit of account is not endangered, so to say. That's what they write there, and they set up 7 principles which should be in place in order to regulate e-money. And I would like only to mention 2 they included in the report. One is actually the legal redeemability and against central bank money at par value. And the second is the need that the EZB can impose a reserve requirement on all issues. And I think that shows us that even though we are facing a lot of new technological innovations, we are still facing well-known challenges in a way. And I think these principles are still in place and still valid for global stablecoins regimes as well, arrangement. So I think a fun fact by the side, if you read this report, it also says that the EZB may define a policy division whether they should issue e-money tokens. No, e-money, not tokens, sorry, e-money back then. So, and that reminds me of the current discussion we are facing with regard to a central digital bank money and currencies, which also shows that the thoughts the EZB has back then when negotiating e-money directive 1 to a certain degree or a very large degree are still, I think, worth acknowledging today. And as you probably realized, these are also things Barry mentioned in his statement with regard to their views on global stablecoins arrangement from the Bank of England.
No, I think it's interesting that you bring it back to the famous ECB opinion on the e-money directive from, what was it, 99 or 2000 or something, because I remember that too. I think the one thing I would say, maybe putting a different hat on because I run the Non-Bank Payment Association, we wouldn't want to see all those stable coins in the e-money directive because there are still these little wallets with existing money in it. But I do think I want to have a small follow-up question to you because I think you raise a really good point, and that is on let's say, thresholds, because we're talking about global stable coins. And then there's within the legislation a number of thresholds to define global. So, wishing Dante all the success in the world, we would assume that Libra will be bigger than most of the e-money wallets which are flying around at the moment under the e-money directive. Maybe not all, but many. So how do you view this point about, distinguishing between stablecoins and global stablecoins? And kind of how do you see the thresholds that are being envisaged by the Commission in there? One of them that I like particularly is 2 million users. Now, anybody in social media, not me, but anybody who's smart, can get 2 million users in a big city in a weekend. So it's quite easy to achieve. Doris, maybe do you want to just kind of react to that?
Yes, just to react shortly. I think the distinction between a stablecoin arrangement and global stablecoin arrangement is a valid one, because due to the potential size, it has different risks and effects on market stability and financial stability, and also consumer protection things. So I think this is a relevant distinction. Yes, with regard to the thresholds, I mean, the only thing I can say as presidency at that moment is that is under discussion, but I'm happy to hear other views on this issue.
Thank you. Maybe, first of all, it's a challenge for the panel this size, so I might take the liberty of, just if you're okay with this, running over by maybe 5-10 minutes, not too long. But I would like to come back to Sharon now, having listened to this, how, question around stabilization, how to oversee these global stable coins. How do you view it from the US perspective? You said you've got your domestic thinking. How does that fit into or compare with what you're hearing here from Doris and Peter and others?
Sure. Thanks, Nick. And with congratulations to my European colleagues on the MICA proposal. I can share a little bit of sort of the way U.S. is thinking about this, these important issues. And consistent with what I mentioned before, taking a risk-based functions approach that I think Klaus and Peter also mentioned, and perhaps a little bit of reflection of the U.S. Regulatory system. You'll note that even back in our executive order report a couple years ago on non-bank financials, fintech, and innovation, we had identified these principles to apply in the context of financial innovation, including in stablecoins. And that's the approach that we're sort of taking. We do not currently, as you know, have a regulatory proposal governing stablecoins, unlike MiCA, but taking again, a sort of a principles-based, technology-neutral, same activity, same risk, same rules type of approach. And in the U.S., of course, when you're looking at different functions in something like a stablecoin ecosystem, there could be different regulatory regimes at play. Payments is, of course, a lot of it is regulated here at our state level. And you can get state licenses. But by way of illustration, I think at the federal level, taking forward this kind of principles-based approach, we can talk about securities. Even if a stable coin is intended for primarily for payments, the tokenization mechanism, unlike sort of the current existing account-based systems, could raise securities laws questions. And an assessment of whether or not it is a security would be consistent with the way we've sort of always applied this under what we call here the Howie Test. It's an evaluation of facts and circumstances to see whether or not it's an investment contract type arrangement. And then if it is deemed a security, then it would be subject to existing federal securities laws that apply to any security, really, in terms of registration, reporting, transparency, obligations, and the like. My SEC colleagues have issued guidance sort of clarifying these potential applications. A second example, similar to what other panelists have mentioned in the context of market integrity and AML-CFT. Similarly, the U.S. covers virtual assets, including stablecoins and virtual asset service providers under our existing AML-CFT regulatory regime. And this would include requirement to conduct adequate risk assessments to understand the risk posed by virtual assets, including stablecoins, and if the risk assessment warrants it, the Bank Secrecy Act it could apply. I guess another example of recent guidance came from the OCC, and here it related to an interpretive letter issued earlier this year clarifying the authority of national banks to hold deposits that serve as reserves for certain types of stablecoins, where it's consistent with existing permissible banking activities. The letter, of course, also noted that new bank activities should be developed in a manner consistent with risk management and other best practices. But I think this gives a little bit of a flavor of the U.S. approach on a principle basis, which we think is helpful given the pace of innovation. For example, as Peter mentioned, not being able to predict new business models or technologies. using a more principles approach allows us to appropriately calibrate regulation, hopefully to adjust to different models and not be prescriptive.
Thank you very much. I think you make a really good point, and I think, Peter, you've made the same in a slightly different way, which is really that it's should ideally be principles based. I think in all areas of high innovation, regulation has to ultimately be principles based, because otherwise it becomes quickly no longer technology neutral, or it kind of makes the whole framework very rigid quite quickly, which was actually one of the questions that came in. To you, Philip, I think having looked at frameworks, to what extent can we rely, as Sharon just said, on other regulatory frameworks? We've got the data privacy framework, we've got the anti-money laundering framework, we've got existing consumer protection law in individual member states. Do we need to replicate all this in the crypto space? Where are the gaps, and to what extent can we rely already on existing regulation or maybe on principle-based approaches as we're looking at this fundamental change over the next decade that you've kind of set out in your 5 use cases?
That's a difficult question, actually. You could write 5 dissertations on this question. That's difficult to answer. But as far as I understood the MiCA regulation, it does include everything which is related somehow to blockchain assets, but leaving aside digital securities, because they are regulated in the securities law. And with this, that's interesting because everything somehow, I'm now very illustrative, right? But everything which is somehow related to blockchain technology and crypto assets is included in the MiCA, leaving aside the digital securities. And I think that's interesting because this way we have a new asset class coming up. But we should also be careful because the assets included or covered by the MiCA regulations are extremely varying. We have stablecoins, we have, of course, assets such as Bitcoin, which should be included. We have utility tokens, we have in the future settlement tokens, access rights. Everything potentially could be included here. So it's not a homogeneous class, but I still find that the European Commission does a good job with basically opening up this small emerging, very varying asset class, by the way, with the MiCA regime, and therefore it's basically filling a gap which is arising through economic growth. It's filling this gap with the MiCA regime. And to be honest, when I read the MiCA in the very beginning, I was a little bit disappointed because I thought, so how can you put all these varying assets in one regime? They are so extremely different. And I had the Liechtenstein Token Act in mind, where they are having an entirely different approach. And then I found in the beginning that the MiCA doesn't really fit because of these building of silos for specific tokens. But when you read more about it and think about it, then it does make sense to have silos to basically restrict companies what they are allowing to do. And it's very positive to have like this gap which is opened up by crypto assets now being filled, or at least trying to be filled by MiCA. There is some discussions going on what's happening with issuer-less crypto assets. Imagine there would be a stable coin which is issuer-less, just algorithmically stabilizing the price. That's a topic for another discussion. This would be interesting to investigate what happens to such advanced modes. But once again, these projects are still to come in the future, and therefore we should also investigate what's happening out there. One last remark here. I think all this technology provides also a huge benefit for regulators, because with stablecoins, they would have the possibility to basically read in the network in real time what's happening in terms of money flows. And that's fascinating because it now allows the regulator not just to regulate rules from the outside, but also to basically monitor in real time what's happening and basically take action if needed. I think there are possibilities here which are opening up these days, which we don't really see yet because these projects out there have not started yet or are about to start.
I think you make a really good point, Philip, there between, I think, whether I paraphrase this correctly, but permissionless and permissioned systems. And yes, I know the text formally has somewhere recited, if it hasn't been dropped between the different versions, saying it applies both for permissioned and permissionless systems. But really, we're looking at permissioned frameworks here. But the other point you raise about transparency is very, very interesting. And yes, we haven't really thought through the implications of that. But I have one really small follow-up question, which is, so it's interesting that you say this, because if we go back a year, we all talked about taxonomies. We love taxonomies in the EU at the moment for everything. But anyway, we looked at the taxonomy for crypto assets. And then we received this proposal where it says there are 3 categories, and there's actually 5. There's one that doesn't apply to anything and one that falls under MiFID. So we've got 5 categories, but it was all brought into 5 categories. And then you've got this alternative model in Hong Kong, if I see it correctly, where everything is at the moment still self-regulated, and there are high-level principles that apply to issuers. So on the continuum of a self-regulatory framework to a very detailed lexicon, you feel the Commission has got it right in the way it's kind of structured the proposal?
My feeling is yes, because it covers probably 95% of all crypto tokens which are out there right now, or at maybe 98%. So it's really covering all large silos. The only thing which need to investigate it is basically what's happening with issuerless crypto assets, Bitcoin and Ethereum, because you can easily create such issuerless protocols by hitting the enter button on your keyboard. We see this in the decentralized finance area. Of course, this area is so small that very often it does not make sense yet to look at it, but you have issuerless loans, issuerless exchanges, decentral exchanges, and all these tokens which are replicating the functions of the capital market. And I feel that this market is developing so quickly that the European Commission could not look at it, because the European Commission started probably 1 year ago. At that time, this decentralized finance protocols or these issuerless tokens have not been a topic so far. So this could be an interesting point to investigate future and to see how this, if there is a gap there, and how it should be tackled, focusing around issuerless tokens.
Thank you very much. That nearly sounds like MiCA 2, which is a bit of a scary thought. But I think with that, Stasis, I wanted to come back to you before I give the 2 industry speakers kind of the final word. Normally, I would give you the final word as our elected representative. But actually, I want to give you an opportunity to respond to what you've heard, and also if you've got some questions to our industry colleagues from what you've heard, to pose those. And so that's why I kind of turned the order around, and I might give Eduardo and Dante the last word exception.
Well, yeah, thank you again. It's very interesting to listen to different aspects and different perspectives, and there are probably more of them. But I would start this intervention with Peter's thought that, you know, the payment function itself is not very high margin, and probably will remain so with the competition growing. And then the other, you know, services and functionalities, you know, subsidize or potentially could subsidize that. That's potentially a good and probably dangerous thing too, because it becomes less transparent. You know, again, Libra comes to mind, and maybe they can respond if they wish to. You know, with them being a data, you know, manager and data service provider, and the advertising company, advertising service provider, and then the payments. You know, you never know what you get. You know, because depends how it's structured, depends how it's managed, of course. But that's why I like, you know, not to compare finance to some sort of I don't know, entertainment, video game, or whatever you take, because it's a serious thing. It's a very dangerous thing. So with the size as it potentially can become, you know, too big to fail, too interlinked to fail, too complex to understand and regulate, and also to understand the real incentives and synergies in these businesses. That could be a headache for the supervisors, be it European, be it you know, global. And I would say that from you know, impression from listening to these you know, interventions, I think this risk of the what I would call supervisory mismatch, taking into account what has been said already and what can be discussed further, it's a big risk. So, you know, once these things are smaller ones, and the you know, point from the Commission, from others is, you know, it's not too large to be systemically important, but structurally, incentive-wise, you know, and if it becomes systemically large and important, that's that's a headache right away. So I think that that's Libra or anyone else, if it develops and grows like that, or becomes something of the entity like that, or the number of entities, it's much more similar to our largest bank, global bank in the world. In addition to with other, businesses, which could be complicated, which could be synergized negatively or positively, and that's, I think, the impression I have. But regardless of that, I think it's very interesting to follow what will be happening. On MiCA, I won't say more than just a preliminary, thought that it's, more or less innovation and reality-driven initiative, which we'll study and discuss with Commission and others more thoroughly, of course, and we'll see how it goes. I'm not sure that I understand everything yet, so we'll need to study it more, to discuss it more, and I don't know what Parliament will think about that, but of course the FinTech Working Group and the Econ Committee, which I'm part of, will be deeply involved with that. So these are my thoughts, which are more or less in line what I thought before, but of course to listen to all these speakers, panelists, was very much interesting. Thank you.
Thank you. It's a shame to hear. I'd hope that you would say you've learned something new and it changed your mind a little bit. But I know that's
well,
maybe when you wake up tomorrow that moment comes.
I don't know about that. I don't want to talk about the psychology, but sooner or later, probably I'll invite people like Robert Schiller and others to discuss about the behavioral and cognitive aspects of the financial technologies. Why not? So that would be, could be a different seminar, or maybe interesting seminar for you to host. We'll see.
Good. I've got one follow-up question before I pass over to Dante and then close with Eduardo. This is a question that came from Piake. I know it was originally directed at Peter Kirstens, but I thought I can kind of direct it at you, which is and I'm paraphrasing a bit, his wording is a bit more direct, but how do you as co-legislator, manage the situation that you don't potentially regulate global stable coins out of existence before they even exist? So how do you find the right balance between the opportunities and the risks? Very difficult question, but I think one that's in everybody's mind.
Yeah, I think it's a valid question, which is a different one. Is sort of suggestive questions that the stable coins and other crypto assets are natural and beneficial development, and how to not to regulate them out or to get them out of the system. But it's an interesting discussion, because some jurisdictions don't allow these things to be part of the regulated financial systems, and I think they have point. China is another example, but we don't want necessarily to follow that. But they are, integrating the platforms and networks within their own decisions on the central bank digital currencies. So I think it's a valid question, but also the valid question is, do we want these things to continue if they pose a significant set of risks and synergies of risks, which I partly tried to mention. So it's not an elementary question, I think.
No, thank you very much indeed. Dante, I think one point that's become clear from Stras's comments is a little bit the distinction between the Libra Association and individual members. But I think maybe say a little bit more about the governance, how you envisage the governance on stable coins, and kind of this argument about, is it building a payments layer on top of kind of other kind of platform synergies which DG Comp is looking at or is otherwise causing concerns in Europe? So A, do you see that concern, and B, what are you doing to potentially mitigate this?
Yeah, I think first and foremost, the question of building fundamental infrastructure is one architected in an open source manner. That is a design principle that is very much pro-competition and pro-compliance. So, once this network is activated, the operators on the network will be a range of digital wallet providers, banks, other operators, and whether they're a member of the Libra Association or not, they'll be able to leverage these digital commons, right? So the open source design principle really supports that. The other point I would make, maybe if this is the last word, is enabling the responsible innovation or evolution of the internal combustion engine in the United States, for example, doesn't kill mobility. It creates companies like Tesla, and with it, it creates a lot of competition around electric vehicles. Not dissimilar to the opportunity in renewable energy, which many once upon a time viewed as a threat. Today, it's a sector that in the US employs more people than the traditional energy sector. I think there's a similar wave afoot in fintech innovation, and what many of us have to figure out how to do is strike the right balance between innovation, competition, and sound approaches and prudential approaches to regulation. Right now, the model that we've partly heard on this call or on this discussion today is about not allowing the innovation to even start before, or even pre-declaring that things might be systemic before they've even launched. And so I do think there is an important pathway here of getting this balancing act right. Innovation, inclusion, and integrity are not trade-offs. So hopefully today's conversation advances that case.
Thank you very much indeed. And I think, Eduardo, I would like to give you the last word. I think obviously respond to anything you've heard, because I think you've been more on the retail side, the customer side of potential stable coins. But I'd also be interested, just coming back to one point Shan made, and we then picked up, which is what other regulatory frameworks impact you? So what's the relevance of AML? We're now seeing work coming out of the FATF and so on. It isn't just about the regulation of the stablecoin itself. It's within an ecosystem of a much broader set of regulatory frameworks. What has been your experience with that? But also, please do feel free to respond to anything else you've heard.
Yeah, no, I would say on the AML side, well, Mexico has made a huge effort to be, on the forefront of all recommendations and compliance, etc. Mexico has, a very bad rep to fight against, especially in their financial system. And many Mexican banks are very reliant on correspondent banks in either the US, Europe, etc. So they have to be extra careful on being compliant on any sort of international recommendations, so that their correspondent banks are comfortable working with them. I would say that the current regulation in Mexico on the AML side, even for fintechs and wallets, complies with all of the international recommendations. It's one of the more, I would say, sore or complicated sectors to comply with for all the fintech sector. And whatever they use for crypto is not any difference. They have to comply with a full KYC regime. They have, to send periodic notices, etc. So the idea is that they are regulated, and there's a very strong regime. Now, having said that, the fact that it's, an immutable blockchain, etc., I think it can help to make a case that if the real life application is found, that it can even be stronger on the AML and prevention of delinquency, rather than what some people think that it is only used for because of anonymity. I would say, that's also an important thing to bear in mind, to see how to use the technology in favor instead of how the bad guys will use it. So that's something that, we've discussed a lot with regulators here in Mexico. And on the other side, I would say that in general, I would add, especially to what Dante said about the innovation. In countries, in emerging countries, or let's say Latin American countries, where financial inclusion is something that we all want, but it's really hard to get. What you have is, let's say, the incumbent banks having already more than enough market share, and for them to reach the lower levels of population is very expensive, and it's not necessarily that, it's not a business. So this is something that a lot of fintech companies are trying to do. And I would say that stable coins and the use they can have, as I mentioned last time, for remittances and other things, is not to be undermined. It's something that at the end of the day, what you want is people to be able to tap the financial system in any way they can. And if it is the way, instead of trying to prevent it, I would suggest trying to regulators try to regulate it and make it in a way that everybody's comfortable, but in a way that is still easily accessible. But because what really generates financial inclusion is the possibility of people accessing financial services easily. Well, at least what happens in Mexico is that you have either millennials unbanked, underbanked, they amount for like 40 million people. And for some reason, they sometimes have more faith in their iPhone or whatever comes out of their iPhone than a huge building of a bank. they feel either, they are afraid, they don't trust, or for whatever reason, they don't want to go to banks. But they do trust these sort of mechanisms where they can access really quick. So that's something to not be, I would say, scared of, but try to adopt it and make it easy for people to access financial services. And obviously, stablecoins plays a very important part in that, because having a stable way to do all of these electronic transactions is very appealing for these customers.
Thank you, Eduardo. Again, I know it's interesting that the debate between Philip, is stablecoin more something for, let's say, business-to-business applications in the widest sense, or is it more at the retail end? I think it's interesting that Dante and you are more on the retail end and the financial inclusion side, which I find fascinating. First of all, big thank you to all of you. I apologize we overran. I think an hour and a half was ambitious in the beginning anyway. But I think you kind of made it a fascinating debate. I think we covered a lot of ground. I thoroughly enjoyed this. And, hopefully we'll see you again. I think maybe 2 or 3 little announcements. Sharon, we're having Heath Tarbert speak next week on some of these issues. So the chair of the CFTC on the commodity side of stablecoins, for those who are interested. And then obviously in February, we will have our FinTech conference, where Commissioner Mairead McGuinness will open the conference. We have a number of very senior speakers where we will revisit some of these points. Hopefully by then, we've seen a bit more progress in the Council Working Group. Doris, you're working very hard on that. Congratulations with that and good luck, and the same with you, Strasses, for the work that's upcoming in the Parliament. Thank you very much to all of you. Have a lovely afternoon or morning in the case of Sharon and Eduardo, and hopefully speak to you soon. All the best. Oh, in the case of Dante too, apologies. Okay, all the best. Bye.
Thank you.